In the 6 months leading up to the great financial crisis, the price of gold surged by 50%. This run-up in gold's price was a major warning for what came next, as investors were flocking to safety right before an almost complete collapse of our financial system. This isn't the only time where gold predicted an economic crisis. In 1973, the price of gold also surged by 50% right before a major economic recession, and again it jumped up by 50% right before the recession in 1980. Fast forward to today, and we've seen gold prices rise by 50% over the last 12 months. Now, this move up isn't quite as aggressive as the one before the financial crisis, which occurred in the space of 6 months, but gold's current run isn't showing signs of slowing down, and many believe that this melt-up in gold prices spells trouble for the future of the global economy. After all, people wouldn't be buying gold if it wasn't in anticipation of some kind of economic or geopolitical trouble. But what exactly is gold signaling today? Is it telling us we're heading towards a financial crisis like 2008, that we're possibly heading for a third world war, or perhaps it's telling us that we're about to see inflation in the United States pick back up? We've been long on gold throughout the entirety of this bull market, with some extremely profitable trades at Bravos Research. So we are in a unique position to talk about this melt up in gold prices and the implications it has on the economy. Now, I can tell you right off the bat, gold is currently sending an ugly warning signal for the economy right now, telling us that things are about to get a whole lot worse. But let's look at how exactly. Today, consumer sentiment in the US is at one of the most depressed levels of the last 40 years of data. That's using data from the famous Consumer Sentiment Survey from the University of Michigan. It's currently at levels comparable to the Great Financial Crisis, the recession from 1990, the recession from 1982, 1979, and 1970. This is not a chart that shows the average person in the US is particularly happy about his economic situation, but gold rising today could be a sign that things are about to get a lot worse. If we add the chart of gold on top of consumer sentiment and we flip it around, we see that the two are very closely linked. As gold prices experience a big bull market, typically it means that consumer sentiment is declining. We saw that between 2004 and 2011, and we've been experiencing the same thing since 2017. If we rewind all the way to the 1970s, we have a very similar situation, where the huge bull market in gold prices was directly coincided with the big decline in consumer sentiment. When gold prices finally reversed, only then did consumer sentiment begin to get better. So this recent rise in gold prices that we've seen is not telling us that things are going to get better. In fact, if anything, it's telling us that things are going to get worse. So again, this brings us back to the question of whether we should be preparing ourselves for another financial crisis if consumer sentiment is really set to get worse from here. In each of these instances, you had a specific crisis, whether that's the European debt crisis, the Great Financial Crisis, the 1990 oil shock, or the recessions from the 1970s. But what's different about all of these episodes is that they each occurred during an economic downturn. When we take a look at the unemployment rate, for example, we see that in all of the cases where consumer sentiment was depressed like today, you typically had a pretty high level of unemployment. In all of these cases, 2008, 1990, 1982, 1974, the economy was going through a recession. Unemployment was on the rise, the stock market was falling, and GDP, so that's the size of the economy, was declining. Today, we have none of those things. The stock market has been on one of the strongest runs in history, all while consumer sentiment is stuck hovering at 2008 levels. This is the K-shaped recovery that everyone is talking about, where the financial system has been diverging away from the real economy. We've seen this to a historic extreme ever since COVID-19. And so gold right now is telling us that this K-shaped recovery could actually be far from over. Now, the million-dollar question is whether this is going to lead to an implosion of the financial system, or whether there's still hope for consumer sentiment to eventually make a comeback, that people can actually start feeling better about their financial situation and feel more aligned with what's happening in the financial economy. In order to answer that question, we need to look at the United States government's debt. This is a chart of federal debt going back to the 1960s. They've been going parabolic since about 2008, and even more so since COVID. Now, if we add GDP, which is the total size of the US economy, on top of this chart of federal debt, we see that throughout most of history, GDP was larger than the size of the federal debt burden. Then something happened in 2020 during the COVID pandemic, where all of a sudden debt became significantly greater than GDP. Now, there are many things that have led to this gap gap developing. There's not one person to blame for this. The great financial crisis was responsible, the COVID pandemic was responsible, and just an overall lack of fiscal responsibility from the government that have led to these exorbitant debt levels. But whatever the root cause may be, the result is that we are in a situation where the government owes much more money than the economy is able to generate through GDP. And so this gap explains exactly why the average American feels so bad about the economy today. Because this is putting the US government in a position where they have to try and lower their spending, potentially reducing access to things like Social Security and healthcare services, but while keeping taxes elevated despite a struggling economy. So in this situation, the average American feels suffocated by taxes that are too high relative to the income that they have. If this trend of heightened government debt burden continues, consumers are going to feel more pain and consumer sentiment is going to get worse. This is at least in part what gold's rise is pointing to right now. However, there could be some light at the end of the tunnel. One of the goals of the current administration is to reduce the tax burden on the working class. The Trump administration has even mentioned the idea of completely removing federal income taxes on middle and lower class workers. We are not a political channel. Our job is to focus on investment research of evaluating the impact that policies and events have on markets. Removing federal income tax could significantly boost the purchasing power of the average American and would be a huge net positive for the American economy. The caveat is that they're looking to finance this through tariffs. As we've discussed in recent videos, tariffs lower corporate profit margins, which increases the chance of seeing a recession, and it destabilizes geopolitical and trade relationships. All of these things increase uncertainty, which is currently what's driving gold higher. But if the Trump administration is successful in reducing the tax pressure off the average American consumer, we think that can have a positive impact on the real economy over the long run. This is why, although we are still long on gold right now, we are steadily booking profits on our positions as it is getting more extended. By the way, if you want to learn how to take advantage of gold, stocks, crypto, and commodities in trading, on our website at Bravos Research, I teach you essentially everything I know about trading markets. How to pick the best setups, how to manage a diversified portfolio of trades, how to adapt according to market conditions, and I send you all of the trades that I make. We had exceptional returns on the trades we sent out to our members in 2024, with 85 winning trades providing a 16% gain each, and with very limited losses on the losing trades. That makes the total return for the year significantly exceed that of the S&P 500. We're working day in, day out to make sure we're delivering the same results in 2025. Our mission is to make every single one of you as profitable as possible in financial markets. Click the link down below if you want to join us.